Okay, good morning. Today we're going to finish up Chapter 5. Starting with what to do this week, we have Attendance Quiz 12, which will be available around, I'm guessing around 1 o'clock today. It'll be certainly available by 5, but it should come up around 1. Chapter 5 homework in my accounting lab, and video quiz 13 is due Sunday. It covers Chapter 6 videos in Blackboard. Yesterday I posted 2 homework problem videos to YouTube, and I did those through an announcement, so you would have gotten an email. It's also posted as an announcement in Blackboard. The 2 exercises, 5-10 and 5-14, one of them is 3 minutes, one's 5 minutes, but it's just I walk through these problems. Exercise 510 has a really good help me solve this on it, but I just walk through it. So if you want to view it, you can. If you don't need it, that's fine. Exercise 514 does not have a help me solve this because it's conceptual, and some of it's true-false questions, some of it's asking other questions. So that one's about 5 minutes, 5.5 minutes. And so those are on YouTube. There is, the link is in the announcement I sent out yesterday in Blackboard. So those are available if you need them. I just looked at what we had for class today, and I was a little worried about having to talk too fast, so I put some of it up there if you need it. We're going to start with a question. Okay? So question, the true-false question. 2 basic ways to estimate uncollectibles, the direct write-off method and the allowance method, true or false. Can you move your cursor, Brian? There, thank you. Okay, I'm going to start here. True or false? True, okay. True. What do you think? False? You are the first falses I've gotten today. Good job. Of course, my FYE students last year. Yes. Okay, this is false, and let's talk about why it's false, because, and there is a tendency, and I understand why we're saying true, but we'll talk about oops, went the wrong way here. Hold on, it'll load. Okay, let it catch up to me. This question is false because there's 2 methods of accounting for uncollectibles. So accounting for uncollectibles, there's the direct write-off method, which is not acceptable under GAAP, and there's the allowance method, which is the method that we use. That's the method of accounting for uncollectibles. This question's asking about how to estimate uncollectibles. When we talk about estimating uncollectibles, we're using the allowance method, and there's 2 methods that we can use to estimate our uncollectibles. That would be the percent of sales method and the aging schedule method. So the choices for accounting methods would be what's in the question, the direct write-off method and the allowance method. The direct write-off method, by the way, it's not acceptable under generally accepted accounting principles except for very, very small businesses. But the direct write-off method says, let's only write off uncollectible accounts when companies actually go bankrupt and absolutely cannot pay us. So what you have if you use the direct write-off method is you could make the sale in 2012, and in 2014 you determine that they're not going to pay you and you write it off. So you've got the revenue in 2012, the expense associated with that revenue in 2014, so you've got a mismatch. So that's why the direct write-off method does not work. What we do with the allowance method is we say, okay, we're going to make sales this period, and a certain amount of our receivables will not pay us. It's just the cost of doing business. So we're going to estimate how much those uncollectibles are under the allowance method to match them with the revenue that we generated. We don't know which ones aren't going to pay us. If we knew which ones were not going to pay us, we would not sell to them, but we don't know. So the allowance method allows us to estimate our uncollectibles to match that with the revenues. And we have two methods for the allowance method. We have the percent of sales, and we have two methods to estimate with. So the two methods to estimate uncollectibles are the percent of sales method and the aging schedule method. And we're going to talk about those. I'm putting up a slide here, the one that's going to load here. I'm going to pause for a minute while you write it down. This would absolutely be information I would put on my reference sheet for the exam. Under the allowance method, we have two ways that we can estimate receivables. The first one is the percent of sales method. This is the easier method. This is simply to say we have $2 million of sales this period, 2% is going to not pay us, or whatever that percentage is. So that's referred to as the income statement method because sales revenue is on the income statement and we're taking a percent of sales as how much our uncollectibles are. The second method, the aging schedule, you have to do a few more calculations. We're going to do a homework problem using the aging schedule. You calculate what the allowance should be. So when you look at an aging schedule, you say, here's all my receivables. Let me take my best stab at it based on what's on my balance sheet of how much is not going to get paid to me. That's also known as the percentage of receivables method. Receivables is on the balance sheet. That's why this is known as the balance sheet method. So again, those are some facts that I would definitely put on my reference sheet. And what we're going to do now is we're going to do the second method. We're going to do the aging schedule method or the percent of receivables method. But we're going to do a few other things with this homework problem. Exercise 5-12. We have a law firm. It gives us some information about their accounts receivable and their allowance for uncollectible accounts. And in the second paragraph, it tells us what they want us to do. They want us to write 4 journal entries. The first 2 journal entries we've already done in other problems, but again, these 4 journal entries are really good journal entries to know. You already know the first 2, but we'll go through them. The first journal entry says to journalize their service revenue. If we look back, we see in the middle of the first paragraph, the 2012 service revenues on account totaled $183,000. Whenever we have service revenue on account, we're writing the journal entry for that. We are going to debit the receivable and credit service revenue. Okay? So we are going to see a journal entry here, debiting accounts receivable, which is an asset, to increase receivable. We're now due this from our customers. And then we're going to credit sales revenue for the $183,000. We've seen this entry before, but this is what it looks like when you have a sale on account. It could be service revenue, it could be sales revenue, it's some type of revenue. you can refer to sales of service as sales revenue or service revenue. You're not going to have to choose between sales revenue and service revenue. You only have one choice, one revenue choice. Okay, next entry, cash collections is on account. So entry B, we have cash collections on account. We look up at that top paragraph and it tells us cash collections on account totaled $133,000. So that's saying we got $133,000 of cash in. So what we're going to be doing is we're going to be debiting cash for the $133,000, and then we're going to be crediting accounts receivable because these are our customers that have paid off their account, paid on their accounts. They've reduced their account. So we're going to have cash debited because we're increasing cash and crediting accounts receivable. So those two journal entries aren't anything new that we haven't done already, but those are very good to know. The entry A was a sale on account. Entry B was received a payment on account. Okay, now entry C and D are different than anything we've done so far. So these are good ones to know. The first one, write-offs of uncollectible receivables. Now this is a very specific thing that they're telling us, and the words are very similar in different situations. But when it says write-offs of uncollectible receivables, we know that this company is using the allowance method because it tells us they have an allowance for uncollectible accounts balance. That means they're using the allowance method. What C is telling us is C is saying, okay, we have determined that some of our accounts receivable, we have identified some people who are never going to pay us, never going to pay us, because maybe they've declared bankruptcy, they've gone through the court system, we can't locate them, we are never going to get these. So what we want to do is we want to pull that amount out of accounts receivable, but we also want to pull it out of the allowance account because we're going to say that we assume that we've already estimated that that was one of the ones that we estimated when we didn't know who wasn't going to pay us. So entry C, we would be debiting allowance for uncollectible accounts and crediting accounts receivable. Writing off a bad account is not the same as estimating an uncollectible account. When we write off a bad account, so this is writing off an uncollectible account. This is identifying someone who's not going to pay us. We've already estimated our bad debts as we went, and this is just saying they're never going to pay us, so we want to pull them out of the list of people that owe us. If we don't pull people out occasionally out of this list of people that owe us, we're going to have this humongous list. So sometimes we say, okay, we're done. We know they're not going to pay us. So we're going to pull them out of accounts receivable. We're going to pull them out of the allowance account. So there is no income statement impact of that. It's just simply taking it out of both places. So that is writing off a bad account once we know it's bad, but there's no income statement because we've already made the estimation. Now we go to entry D. Now entry D, I'm going to put the entry up here. I'm going to let you write it down. I'm going to point out some information, and then I'm going to talk through the entry on the next slide. So I'm going to write there's the entry, and there will be an explanation coming up here. So write it down for now. We're going to debit uncollectible account expense or bad debt expense and credit allowance for uncollectible accounts. Brian, did he do the type, since you can't hear what I'm saying, did he do the audio wizard? Because that, okay. Our entry's there. I'm going to go on the next page and show you how we get that. But before I go there, up at the top I've highlighted two numbers. First of all, an allowance for uncollectible accounts, $2,000 at the beginning. That is our beginning balance for the allowance for uncollectible accounts. So they are giving us $2,000 as the beginning balance, and that's that first highlight there. The second highlight, at the end of the year, the aging of accounts receivable, so we went through and we determined that the allowance account should be $1,790. So they're giving us what the allowance account is at the beginning of the year, the balance in the general ledger. Then they're telling us what it should be, because they looked over our list of bad debts and or our list of accounts receivable, and they said, I think that generally this is what we're not going to be able to collect on. So those two facts combined with what we've done so far. So on the next page, it also tells us to prepare a T account. So on this next slide, what I'm doing is I'm taking away the problem, the top part of the problem. I'm going to list all 4 journal entries, and then I've done that T account at the bottom. So I'll let you catch up on the writing the T account. You already have entries A through D, but write the T account, and then we're going to talk through how we get to the solution from here. So we have this T account, and what we're doing here is we're going to show how we got that journal entry amount. Okay? So our T account, allowance for uncollectible accounts, the beginning balance was $2,000. Our ending balance, Brian, this is what I'm doing. Okay. Okay, so our beginning balance was given to us, our ending balance was given to us. So now what we're going to do is I'm going to show you how we get to the balance of the journal entry amount of $2,290. First thing we do is we go through the 3 journal entries we've written up to this point. So A, B, and C, okay, because we're working on D right now. So in C, we see that we had an entry for allowance for uncollectible accounts. We had a debit of $2,500. Allowance for uncollectible accounts is a contra asset. It has a normal credit balance. So the beginning balance is on the credit side. The ending balance, what we want, is on the credit side. We have a debit to write off because that's what our journal entry was for. So now we have this situation where we have a beginning balance of $2,000. We have a debit of $2,500, but we want our ending balance to be $1,790. So what we end up having to do is solve for X, and X will be on the right-hand side, and I'm going to show you how I got to $2,290 in just a minute, how the math is. But what we have then is we have $2,000 plus something minus $2,500 equals $1,790, and that X is $2,290. And down there at the bottom then, I said what we take 2,000 plus X minus 2,500 equals 1,790, and we can solve for X then, giving us 2,290. Contact Collaborate chat room. They can help. So those are the 4 entries, and then that last bit is how we got the entry for D. What we did in D, we did the aging method, or the percentage of receivables method, the aging schedule method. So what we had to do, what they told us was they told us the beginning balance, they told us the activity in the account, and then what the ending balance should be, so we had to solve for that missing one. So that second method requires a few more steps. The percentage of sales method just says here's our sales times 2% or whatever the percentage is. So this is the aging schedule method. So that, I think, is it on this. Yes, that's it on that problem. So we're going to go from there into another question. Okay, I'm going to back up and I'm going to take that because that's way too much to type. Okay, the difference, there's a question about what's the difference between C and D. Okay, so I'm going to back up here. Let me see. I'm going to the problem itself. I'm just waiting for the problem to load. It was what they were asking for. Okay, and the problem is going to load. Okay, so entry C said write-offs of uncollectible receivables. Write-offs of uncollectible receivables, very specific terminology. What that is saying is we're going along. Let's say we have one customer, Joe Smith, and Joe Smith, we sold to him last year. We sold $10,000 worth of stuff to him last year, $2,500 worth of stuff last year, and this year, Joe Smith declares bankruptcy. He's gone through the court system. We will not get a dime of what he owes us. So this is a write-off of uncollectible receivable. We know Joe Smith is not going to pay us. So we have specifically identified a particular customer who's not going to pay us. So entry C, we're taking Joe Smith's account out of our list of accounts receivable, and we're also taking it out of the allowance account because we figure Joe Smith, that $2,500, did we know back when we sold him that stuff that he was not going to pay? No, we had no idea. We estimated as we went along. Well, now we found somebody who's not going to pay, so we say, okay, we've got to pull him out of accounts receivable and allowance account. So entry C is specifically for writing off an uncollectible receivable. That's where we have specifically identified old accounts that are never going to pay us. So that's C. Now D is estimating what we're not going to get, and that's typically we're doing the aging schedule, so it's based on what we have, looking at our crystal ball, looking for an estimate. In entry D, this does not relate to any particular customer. This is just in general, how much do we think in total we're not going to get? But we don't know who's not going to pay us. This is getting us to a general estimate. So it's based on percentages over time of who pays us and who doesn't pay us. C and D are both uncollectible accounts. C is identifying an old account that is not going to pay us, so we're taking it out of our list of accounts receivable and allowance. Entry D is estimating based on what we have right now, but entry D, we don't know who entry D relates to. We have no specific person. It's just estimating the amount either based on this year's sales or what we've currently got in receivables. Okay, so now we're going to go to a question. Under the allowance method, everyone should get this one right because we just did this entry. Under the allowance method, the entry to write off a $2,600 uncollectible account, so this is an account that we've identified, includes what? What do you think? Yeah, and that would be, yeah. Okay. Based on my sample of 1, what do you have, Brian? Yeah. Yeah. You have a lot, you have D. Is that what we said it was? Okay, yeah. Oh, I was looking at this. Yeah, okay. What we've got here, this is helpful when you answer this kind of question. When it says the entry, you should be looking at your list of entries to determine, what are your choices here. The entry to write off a specific account. This was like entry C on the exercise we just did. So we had a debit to allowance for uncollectible accounts. We had a credit to accounts receivable. So that is what the answer potentially could be, so we can compare that to our choices. But just wanted to bring up that allowance for uncollectible accounts is a contra asset. So it's opposite of the other assets. So our entry is going to be D, based on this debit allowance for uncollectible accounts and credit accounts receivable. So D was the one that fit with that entry. Okay, next slide, I just have a note, kind of a vocabulary. When we talk about net realizable value, that refers to accounts receivable. So this next slide, I've got some abbreviations on it. Okay, AR abbreviates accounts receivable. You don't necessarily need to memorize it, but accounts receivable minus the allowance for uncollectible accounts gives us this term called net realizable value. And net realizable value is a pretty common term, or we might talk about accounts receivable net. But when we talk about net, it means we're taking gross accounts receivable. We don't ever see the word gross anywhere, but we're talking about accounts receivable, subtracting the contra asset, subtracting the allowance for uncollectible accounts gives us this net realizable value. By allowance, I mean allowance for uncollectible accounts. We just refer to it as allowance. I mean, you'll always see allowance for bad debts or allowance for uncollectible accounts, but there is no other allowance account we use. So if you see allowance, you can feel pretty comfortable it's got to do with this. Okay. Okay. We have another question based on this very concept. We have a company reports accounts receivable on the balance sheet at a net realizable value of $586 approximately. If its gross receivables were $612, then what's the balance in its allowance account? Okay, you have an answer? A? Okay. Do you have an answer, Brian? 12 A's? 16 A's? Okay. Just keeps growing. Okay. And the answer is indeed A, yes. And how we got that is we're saying that the net realizable value, the bottom, is 586. 592, and the top number, gross, is 612,854. So the difference between the two was 26,262. Okay, another question. This one's a true-false, and this one gets into shipping terms. The next one, FOB shipping point, FOB destination, understanding the difference between the two. This is a true-false. When goods are shipped FOB destination, the revenue is recognized by the seller when the goods leave the seller's shipping dock. Is that true or false? What do you think? True? Okay. What do you think? False. Okay. True. What do you think back here? True. Okay. True. What about down here? All of you. You. True. True. Okay, truth. Now, on this is actually a good one to know. I would make notes in my notes about what FOB destination means and FOB shipping point means. FOB destination means that revenue is going to shift, is going to be recognized when it arrives at the destination. FOB shipping point means revenue is recognized when the goods leave the shipper shipping dock. So you have a destination and you have a shipping point. And whichever one is named after FOB is when revenue is recognized, when the sale is recognized. It depends on what's listed after FOB. Another point that I would put on that reference sheet. Okay. So FOB, this is false because if it were true, it would say when goods are shipped FOB shipping point, revenues recognized at the shipping point. So whatever I would write down about this, whatever follows FOB is when revenue is recognized. Okay, and now those were shipping terms. Now we're going to move on to credit terms. And this again is, we did a problem on Tuesday about this, but these are credit terms. Credit terms are expressed like we have here. This is an example. The first number there, the 2 in this example, refers to a discount. So this example is 2% discount. The 10 refers to how many days are in the discount period. So in this case, if you pay within 10 days of the invoice, you get a 2% discount. And that, remember, a day of sale doesn't count. The second part of this, the N30 or net 30, says if you don't pay within the discount period, you owe the entire invoice within 30 days. This could say if this started 1/15, that would be a 1% discount in the first 15 days. You could have N45, you could have N60. It's just telling you that you have to pay within the 30 days in this example, or you take a discount in the first 10. If you don't pay in 30 days, you've got things like you've got potential fines, penalties for paying a late payment fee. You can take a hit on your credit rating. The buyer may not, or the seller may not sell to you on credit again, so that has to do with your credit worthiness. But these are credit terms, and that's how you interpret credit terms. So another question relates to another vocabulary term in this chapter. "30 days would be the entire period. So 30 days from invoice date. Okay, the separate account for each customer is kept where? Okay, the separate account for each customer is a subsidiary ledger. So we're going to talk about the difference between a general ledger and a subsidiary ledger. A general ledger is where we keep all our activity. So every time we have, for example, an accounts receivable is going to hold all the information for every transaction we have with accounts receivable. So we make a sale on account, it goes into accounts receivable. When a customer pays us, it comes out of accounts receivable. So the balance of accounts receivable relates to every single customer. We have one balance total for the whole company. But as a business, we need to be able to manage what's owed to us, and we need to know how much each individual customer owes us. So we have something called a subsidiary ledger. And a subsidiary ledger means that we have a record for each individual customer of how much they bought, how much they've paid off, and how much that individual customer owes us. If we add up all the records in the subsidiary ledger, they will total the general ledger account for that, for the accounts receivable. We can have subsidiary ledgers for lots of different accounts, but we can have a subsidiary ledger for accounts receivable, for accounts payable, and then things like equipment, things like that. But a subsidiary ledger contains detail for the general ledger account, because the general ledger account is one big total for the company as a whole. Subsidiary ledger gives us the totals because we certainly need to know who owes us what. So if you type in the computer and go into a customer's record, that is a subsidiary account, not the entire general ledger account. We're going to do another homework problem now, and now we're going into notes receivable. So accounts receivable is typically generated when we sell to customers. Notes receivable have interest on them, and there's an actual signed note. Typically, if you borrow money from a bank, it's a signed note. A company can sell with a note as well. I know where I used to work, when we would sell forklifts, or tow motor, when we would buy forklifts or tow motors, the tow motor company would actually have us sign a note that said we would pay for the forklift over the next year, and we would have payment terms and we would pay interest on it. So we can have notes receivable or accounts receivable. Accounts receivable typically doesn't have interest, a note does. So exercise 515, we have a bank lent the money, $150,000, to Summers on a 3-month 8% note. And we're recording to the bank. So that's important to note that we are looking at this from the bank standpoint. First thing we're going to do is lend the money on February 10th. So when we loan the money on February 10th, we're the bank. What we're going to do is we're going to have notes receivable debited. We're increasing our receivable, and we are going to credit cash because we're giving cash to Summers. So we're loaning money out. So this is going to debit notes receivable and credit the cash. Okay, so that's what we're going to do on February 10th when we loan money out with a note. We are never going to have any partial payments for our homework. So whether that happens in real life or not, I mean, I think it might, but it just depends. We're not going to get that detailed. There is somewhere fine print that defines whether you can do that or not. But for the purposes, well, yeah, we did one on Monday. We did a problem on Monday where they returned merchandise and they still got the discount on the remaining balance. Yeah, but anyways, that would be part of the fine print. Yeah, and we will not have any in here where we have to make the distinction between a partial payoff and a full payoff. Okay, next, collecting the principal and interest at maturity. Specify the date. This is a 3-month note. So when it says months, we just go by months. We don't convert it to days or anything. So if we lent it on February 10th, then 3 months later is going to be May 10th. So we have May 10th. What's going to happen here is we have to calculate the amount of interest. So I'm going to wait while you write that down, and then I'm going to walk through it. This tells us that this is a 3-month 8% note. The 8% is on an annual basis. All interest rates are virtually always expressed on an annual basis. The interest on this note for the 3 months. It's a 3-month note. So we're going to take the principal. So now I'm starting at the bottom of the journal entry. I'm starting with interest revenue. To calculate the interest on the note, I'm going to take the principal of the note, which is the $150,000. I'm going to multiply by 8% the annual rate. Now that's for a whole year, so I need to adjust it for the 3 months. So I'm going to multiply by 3 months divided by 12. So I get $3,000 as the amount of interest for 3 months. That's my interest revenue. My note receivable credit, I'm just going to work my way up on this one. I'm going to cancel out the original note because they don't owe the bank anymore once they pay it off. So we're going to take out the $150,000. And the amount of cash that the borrower has to pay the bank at the maturity is the principal plus the interest, so the $150,000 plus the $3,000. Okay? So we will have on May 10th, the bank will receive $153,000. $150,000 is the principal and $3,000 is the interest. We're going to do another problem coming up here where we go a little further into interest calculations. So we'll see that more on that coming up. Okay. And another question, and this was one we had quite a few wrong this morning. So let's see on this next question. It's true, false. The creditor has a note payable, true or false? So what do you think? False? Okay. False. So everybody's going to be right or everybody's going to be wrong, right? Look at that. Okay. What do you have online? Wow. Okay. So predominantly you guys are right. Okay. It is false. The creditor has a note receivable, actually. The borrower has a note payable. So remember, the creditor is the one loaning the money. The creditor is another name for lender. When I was working on what we were going to do in class today, I thought I had a lot of material. So, I put the 2 homework problems on, and I emailed that out yesterday. Well, I have the next thing I have coming up here are I had 2 attendance quiz questions. You could very well, more than likely, get one of these questions or both on your attendance quiz. And they were kind of lengthy. So I did a quick 2-minute YouTube video. This is not posted anywhere. This is your bonus for coming today. So if you want the answers for these 2 attendance quiz questions, that is the URL you need to get to. It will not be posted anywhere else. The only way you can get to it is through here. It's not, you can't get to it through the YouTube channel. It's here. Okay? So tiny.cc/feb27. You're certainly welcome to try the attendance quiz questions on your own, but here's a way the answers given for 2 of them, where I actually walk through them. I just thought I'll put it in a different format. I was just a little worried about having to talk too fast. So there you go. There's your bonus for today. Yeah. Okay, next, another homework problem. We're going to do more on the interest now. This is a 3-part exercise. The first part says, compute the amount of interest during 2012, 2013, and 2014 for the following note receivable. So in this case, we have a note receivable that is for 2 years. On May 31st, 2012, the bank lent $220,000 to Bob on a 2-year 8% note. What I've got in red up there, the bold formula, interest equals principal plus interest times interest rate times the months divided by 12. That's what we're using, and that's what we used in that last problem. We always will calculate interest based on months. If we were given a note that had days, then we would do it based on days, and it'll tell you how many days in a year to use. But I believe all of ours are based on months. Okay, so you just go with a month. It'll be a complete month. You don't have to worry about fractions of months. We just go with full months. Also, when you're doing these, in this particular one, we have some rounding involved. You use the 5-4 rule with rounding. In this particular one, for class, we're rounding to the nearest whole dollar. And the nearest whole dollar, so we're going to use, if it's 5 or higher, we'll go up. If it's 4 or lower, we'll go down. In my accounting lab, it should say, usually in green at the bottom of the problem or somewhere in the problem, what to round to. If you ever have any doubt, you can click over into the Help Me Solve This. So this first one, May 31st, we lent $220,000. So we have to communicate the amount of interest during 2012, 2013, 2014. So dealing with 2012 first. We loaned the money on May 31st, 2012. So $220,000 times 8% times the number of months in 2012. So we look, we don't count the day we loaned the money. So we have June through December, and you may want to count on your fingers or whatever. The biggest problem I see with people getting these wrong is they use the wrong number of months. So you want to be really careful to count the number of months. So in this case, we have 7 months. That's June through December is 7 months. So we're going to take $220,000 principal times the 8% interest rate times 7/12 to adjust for the portion of years that this was outstanding. And again, we're rounding to the nearest whole dollar. So we have $10,267 as the interest for that first year for 2012 because we loaned it on May 31st. So it's not outstanding for a full year. Next, we go to 2013. This is a 2-year note. So 2013, we can take the whole interest. $220,000 times 8% is our interest for 2013. There's no adjustment necessary. We could multiply by 12 over 12, but it would be the same. So we're going to have $220,000 times 8%. And again, keep in mind that those interest rates that are stated are annual interest rates. Okay? And this isn't unique to your homework. This is in real life. When you see an interest rate, typically they are stating the interest rate on an annual basis. That refers to how much interest you're paying on an annual basis. So for 2014, this note gets paid off. It matures in 2014. It was a 2-year loan. So on May 31st, 2014, Bob is going to pay the bank back. So what we're going to have for interest for 2014 is the $220,000 times the 8% times the number of months in 2014. So we're going to have 5 months in 2014. So we will have 5 months would be January through May. It gets paid off May 31st, 2014. So 5 months of interest. That is part 1. That's how we do the interest calculation in part 2. Part 1. In part 2, it's just saying which party has a note receivable and which one has a note payable. Okay. Note receivable. That would be we've got the bank and we've got Bob. So the bank has a note receivable. Bob has a note payable. The bank has interest revenue. Bob has interest expense. The dollar amounts will be the same for both parties. Just one accounts for it as a note receivable. One accounts for it as a note payable. One has interest revenue, the bank. Bob has interest expense. Now, in part 3 says, okay, let's say that the note, that Bob doesn't borrow the money for the full 2 years. Instead, in Part 3, it's saying how much would the bank collect if Bob paid the note off on November 30th, 2012. So the bank loaned Bob the $220,000 on May 31st, 2012. In Part 3, Bob's paying back the money in that same year on November 30th. So what we're going to have there is we're going to have 6 months that that note was outstanding. If we count them, we have June, July, August, September, October, and November. We have 6 months that note is outstanding. So they want to know how much the bank would collect. The bank is going to collect, first of all, principal. Okay, the principal, when we pay something off, the principal is the $220,000. The bank is also going to collect interest, and that's what I was saying. We have 6 months of interest. So in Part 3, we're saying, wait a minute, he didn't want the loan for the whole 2 years. He's able to pay it back after 6 months. So the interest is going to be $220,000 times 8% times 6 months divided by 12, because this was only outstanding for 6 months. So we get $8,880. So the total amount that the bank would receive on November 30th, 2012, if Bob were to pay this off early on November 30th, would be $228,800. When the note's paid off, you're going to get the principal and you're going to get interest. We have another question coming up with another term, maturity value. So this is true or false. The maturity value of a note is the sum of the principal less interest due at maturity. What do you think? True? What do you think? False? And this one is false, and it's only because of one word. Okay? It's the principal plus the interest due. Okay? So we maturity value is always going to be the principal plus the interest due. Just like in that problem where we just did it, we took the principal of $220,000 plus the interest was due. That's maturity value. Okay, now we've come to, I guess I missed that just a minute. We are technically at the end of the material. I guess putting the problem, we're out a little bit early, so I hope that's okay. So have a nice weekend. What's due this weekend, the attendance quiz 12. Today it's coming available, but it's due Saturday, Chapter 5 homework, and video quiz 13 is due Sunday.